Welcome to this video on next week's meeting of the Fed and the ECB. I don't expect any more jumbo rate hikes of 75 basis points next week. Instead, both central banks are likely to raise their policy rates by only half a percentage points. That's pretty clear from the central bankers' public statements. Regarding the ECB, it will next week decide on how to reduce its huge bond holdings. It will not sell bonds explicitly. Instead, it will reinvest only half of the maturing bonds, but this would reduce the ECB bond holdings by only 3% a year. That is not much. The ECB is taking into account the highly indebted countries in the south of the monetary union. Regarding policy rates in the US, the federal funds rate will already be at 4.5% after next week's meeting, so it's already quite high. But because wages have been rising more strongly again recently, the Fed is likely to raise its policy rate further to 5% by spring next year and leave it there for a longer time. The policy rate of the ECB is likely to be only at 2% after next Thursday's meeting. That is low, and most ECB Council members want to raise it further next year. I continue to expect rate hikes to 3.0% until spring. The ECB is then likely to pause there. Finally, inflation will fall again in the course of the coming year because energy prices are unlikely to continue to rise as quickly as this year. Regarding financial markets, the expected end of the rate hike cycles in the US and in the Eurozone in the spring of next year suggests that there will be some easing on the financial markets. As a result, bond yields are likely to fall again somewhat next year. Equity should recover significantly after a volatile first quarter.